Elon Musk is poised for a hostile takeover of Twitter. An incredibly wealthy person quietly accumulated shares in a company some deemed undervalued. That investor has gone public with concerns about the firm, questioning everything from its basic revenue model to employee culture, and rejected an offer from the business to join its inner circle and call off an attack. We've seen where a scenario like this ends up dozens of times over the past decade. The rich shareholder is perfectly positioned to initiate a hostile takeover of a company, and now that's the reality confronting Twitter after Elon Musk has decided not to take a board seat, a role for him announced with some fanfare last week by CEO Parag Agrawal and founder Jack Dorsey. A day earlier, Musk, the world's richest person, had revealed he amassed a 9.2% stake in the company, making him the company's largest shareholder. This now goes from a Cinderella story with Musk joining the Twitter board to a likely Game of Thrones battle between Musk and Twitter, says Dan Ives, a Wedbush analyst who covers Tesla, one of two companies Musk runs. SpaceX is the other. What happened? Over the weekend, Musk took to Twitter to throw out a number of suggestions for changing Twitter. Musk suggested Twitter could change nascent plans around its subscription product, Twitter Blue, and seemed to advocate for eliminating ads, which account for nearly all of Twitter's $3.7 billion in annual revenue. Further, Musk threw out ideas for Twitter's headquarters converted to a homeless shelter, and even the company's name, dropped the W to form a crude joke. When Musk talks, he reaches an incredibly wide audience. He has over 81 million followers on Twitter, making one of the most closely watched people on the app. But most startling was his tweet on Saturday posing this question: is Twitter dying? It was Musk's pointing out that some of Twitter's most followed accounts rarely publish content, drawing attention to limited activity from accounts run by celebrities such as Rihanna, Justin Bieber, and Taylor Swift. Musk's tweet storm further unnerved Twitter employees who already ended the week worried what effects his disruptive presence would have on the board. His tweet about Twitter and the inactive but widely followed accounts drew swift condemnation from Gaudis Rivera, the company's global director of culture and community. As a frequent tweeter, you should know that follower count isn't always king, she wrote in a tweet, replying to Musk's original. Quote, people who push conversations forward, build equity within communities, and offer unique perspectives are what makes this app vibrant. Agarwal and Dorsey had worked to quickly embrace Musk, praising him on Twitter and announcing his board seat a day after Musk. Twitter successfully tried a similar strategy with activist investor Elliott Management in 2019 when it acquired a stake in Twitter and sought changes at the company. But the plan didn't seem like it worked as well as with an investor like Musk, who has channeled a chaotic management style while running Tesla and SpaceX, often using Twitter to publish controversial statements about those companies' plans. The agreement would have put Musk on the board included a stipulation. Musk couldn't accumulate more than 14.9% of the company. Since he's not joining the board, he can buy as much stock as he can. Much of his fortune is in Tesla shares, so if he wanted to launch a takeover bid, he'd likely want to team up with a private equity firm or some other financier. Twitter doesn't have the dual share classes that many public tech companies like Meta, Alphabet, Snap do. Those systems leave voting rights and control, of course, with a company founders, protecting them against Musk. Without this, Twitter could adopt a so-called poison pill plan, a costly move where it sells stock at a discount to dilute an aggressive shareholder's stake. Kohl's and Papa John's have both adopted such plans over the past couple of years to ward off encroaching investors. Twitter shares fell 3.7% in pre-market trading today, had been hit in recent months over concerns it would fall short of goals set by Dorsey before his departure to dramatically expand revenue and users by next year. The stock lost nearly half its value from October through March. The company has long struggled to marry its culture importance with a strong business engine. It was founded in 2006, went public nearly 7 years later, and saw its stock approach $70 a share a few months after the IPO. But shares have languished after that and didn't climb above 70 until the pandemic, when Twitter and other internet companies that saw a huge surge in users during the lockdown. The discount between a promising company under-delivering is often a lure for a corporate raider who sees an opportunity to buy up stock on the cheap, improve business, and sell out at a profit. Remember, Elliott did this very thing, buying up shares in 2019 before winning several concessions from Twitter management, including more aggressive growth targets and a success plan for Dorsey. Dorsey left Twitter in November, turning the CEO job over to Agarwal. Musk's arrival last week buoyed the stock significantly, and even after the pre-market sell-off, the shares are up nearly 20% since he unveiled his shareholding. This means Musk has made it more expensive for himself if he does choose to go Game of Thrones on Twitter.